Right now, there is about $21 trillion sitting in American bank accounts. But here's the thing. Most of that money doesn't actually exist. Not physically, not in any vault, not anywhere. And the people who run this system, they built it that way on purpose. Think about the last time you deposited a paycheck. You handed money to a bank and the bank promised to give it back whenever you asked. That sounds safe. That sounds like a storage unit for your cash. But that is not what a bank is. A bank is not a storage unit. A bank is a machine that takes your money and immediately bets most of it elsewhere. The moment your paycheck hits your account, the bank has already spent it. And the crazy part, this is completely legal. It has a name. It is called fractional reserve banking. And once you understand how it works, you will never look at your bank account the same way again. To understand fractional reserve banking, we need to go back about 400 years to 17th century England. Back then, people stored their gold with goldsmiths. Goldsmiths had big vaults, strong locks, and a reputation for keeping things safe. When you deposited your gold, the goldsmith gave you a receipt. That receipt said, "This person has X amount of gold. Pay them when they ask." Pretty soon, people started trading those receipts instead of the actual gold. Why carry heavy gold when a piece of paper does the same job? Now here is where it gets interesting. The goldsmiths noticed something. People almost never came back for their gold all at once. At any given time, only a small fraction of depositors wanted their gold back. So the goldsmiths thought, why not lend out some of this gold and charge interest? They kept a fraction in reserve, just enough to handle daily withdrawals, and lent the rest. They were now creating money that didn't fully exist. This was the birth of fractional reserve banking. And 400 years later, your bank is doing the exact same thing with your paycheck. Here is how the modern version works. You deposit $1,000 into your bank account. Your bank is required to keep a fraction of that as reserves. Historically, the Federal Reserve required banks to keep around 10%. So the bank sets aside $100 and lends out $900 to someone else. Let's call him John. John uses that $900 to buy a used car. The car seller deposits $900 into her bank. Her bank sets aside $90 and lends out $810. That $810 gets deposited somewhere else. That bank lends out $729. And on and on. Your original $1,000 has now created nearly $10,000 in total bank deposits. $1,000 became $10,000. Economists call this the money multiplier, and it means that banks are not just storing money, banks are manufacturing it. Now pause here because something important happened in 2020. The Federal Reserve actually eliminated reserve requirements entirely. That's right, zero. Banks in the United States are no longer legally required to hold any minimum reserves. Instead, the Fed shifted to what it calls an ample reserves framework. The system now runs on capital requirements and interest rate controls instead, which means the old 10% floor is gone. The multiplier effect still exists, but it is now governed by different rules. Rules that are harder to explain on a bumper sticker. Here is the part that should make you uncomfortable. Right now, if every American tried to withdraw their bank deposits at the same time, the money would not be there, not even close. For every dollar held in reserves, banks have issued roughly $4 in deposit claims. In 1985, that ratio peaked at nearly 12 to 1. 12 claims for every one real dollar. The only reason this works is because we all believe it works. Your $1,000 is safe because you believe the bank has it. Your neighbor believes the same thing about her $1,000, and her neighbor believes the same thing about his. As long as nobody panics, the system holds. But the moment people stop believing, that is a bank run. That is exactly what destroyed 9,000 American banks during the Great Depression. That is exactly what killed Silicon Valley Bank in 48 hours in 2023. SVB had $175 billion in deposits. When rumors spread that it was in trouble, customers tried to pull $42 billion in a single day. The bank collapsed before breakfast the next morning. The whole system runs on confidence, not gold, not cash. Confidence. Here is the uncomfortable truth that most people miss. This system was not designed to protect you. It was designed to grow the economy, and it works spectacularly. Fractional reserve banking is why businesses can get loans to expand. It is why people can get mortgages to buy homes. It is why the U.S. economy can function at the scale it does. Without this system, credit would be so scarce that economic growth would slow to almost nothing. So the question is not whether fractional reserve banking is good or bad. The question is, who controls it? And the answer to that is the Federal Reserve, 12 people who meet 8 times a year to decide how much money America is allowed to create. That is the real story here. Not the banking system itself, but who holds the lever and whether they always use it wisely. The money in your bank account is real, but it is also, in a very meaningful sense, a collective agreement, a promise backed by confidence, regulation, and the assumption that you will not need it all at the same time as everyone else. So here is the question I want to leave you with. If the system runs on belief, what happens when people stop believing? That answer is the subject of the next video. If you want to understand who actually controls your money and how they do it, subscribe. Because we are just getting started.